What is digital credit and why is it a big deal? Michael Saylor has created the term digital credit, which effectively means USD credit backed by Bitcoin collateral. Bitcoin treasury companies are issuing this credit in the form of fixed income securities, or mostly now preferred equity. The money that they raise by issuing this credit is used to acquire Bitcoin. An example of this might be something like STRC, which is Strategy's most recent preferred equity product. It is traded on the Nasdaq and it is available in almost every brokerage account at this point. It is effectively like a pseudo money market fund or a pseudo long-term savings account. Strategy aims to peg STRC at around $100 per share, and it pays a variable yield that is currently a little over 10%. This is a really big deal for a number of reasons. One, it is enabling Bitcoin treasury companies to borrow money at a fairly attractive rate with long duration leverage, as STRC and their other preferred equity securities are still perpetual preferred equity securities, meaning that the money never comes due. There is also no short-term liquidation risk in case the price of Bitcoin falls aggressively in a short amount of time. This enables Bitcoin treasury companies like MSTR to get significant leverage in the form of preferred equity against digital capital, Bitcoin. This obviously creates an amplified version of Bitcoin. On the credit side, this is a game changer when it comes to storing money in a high yield savings account or money market fund. Yes, there is additional risk with digital credit products like STRC, but they pay a significantly higher yield than comparable products like savings accounts and money market funds. Where this gets really interesting is you can go on Strategy's website, look at their credit tab, and play around with different assumptions. You can take the assumption that Bitcoin is going to continue growing in a widely volatile manner, maybe a 30% CAGR with 40% volatility. In that case, you can create a statistical model that shows how much risk these digital credit products have, and if you assume that, it is very low risk. You can also take a pretty pessimistic scenario and assume that Bitcoin might grow at 0% for the next 10 years and still have volatility of 40%, meaning Bitcoin can go down a lot or it could go up a lot. Even with those assumptions, arguably these digital credit products are still significantly mispriced. My base case is obviously closer to 30% growth with 40% volatility. But even if you start to think that maybe Bitcoin's growth will slow closer to 0%, then maybe it would be reasonable to expect Bitcoin's volatility to decline because it is not growing as fast. I think volatility is a symptom of its rapid growth. If you adjust the model and assume that Bitcoin's volatility declines, even with a 0% Bitcoin CAGR, then STRC and these digital credit products are still even more mispriced. This effectively means you can be a pretty big Bitcoin skeptic, and it still makes statistical sense for you to buy these fixed income products if you are a fixed income investor. Where this gets even more fascinating is when you realize most dollars that exist today, or most of the dollars that we think of as being dollars, are effectively dollar credit. For example, bank deposits are not actually dollars. They are dollars credited to your account that are backed by other assets like mortgages. With a product like STRC, we are actually creating more dollar credit, or essentially more dollars in the system, while simultaneously acquiring Bitcoin. This dynamic resembles what is often called a speculative attack. Whereas more dollars get created, the supply of dollars increases and the dollar itself becomes devalued. At the same time, these newly created dollars are being used to acquire Bitcoin, which effectively decreases the effective supply of Bitcoin and increases its marginal price. This could set off a very powerful positive feedback loop. Now, the whole point of this is to show that digital credit is the way people can get amplified exposure to Bitcoin, and it clearly has the potential to disrupt the entire $300 trillion fixed income market and begin bringing that capital into Bitcoin. This is a really big deal, and it does not even require that you be a huge Bitcoin bull. You can be a skeptic and think it could go down a lot or up a lot, and these products are still arguably statistically mispriced by the market. A lot of capital, perhaps trillions and trillions of dollars, should be flowing into them or will be. Thanks for watching, everyone, and see you next time.